Hi, I'm Tom Lydon, editor of ETF Trends here in Chicago at the Morningstar ETF Conference. And I'm here with Simeon Hyman, who's head of investment strategy at ProShares. Simeon, thanks for being here.
Thanks so much for having me.
Listen, we're going to talk about dividend growth and, what's attracting investors to dividend growth strategies these days?
Tom, it's just a great shorthand for finding great high quality companies that are continually telling you that they're in good shape and their prospects are good.
Right. So ProShares tackles dividend growth a little bit differently than the others. Walk us through that, and how is that different?
Well, we wanted to do a couple of things. One, we wanted to focus on strategies where the underlying indices were the most popular indices for their asset classes. So for example, we have ticker NOBL Noble, the S&P 500 Aristocrats. So that's a great plug and play to your core US equity allocation. We also have ticker EFAD, Dividend Masters, based on the MSCI EFI index, which of course is the biggest index in the international developed space. Yeah. So we wanted them on the dominant indexes in their class, and we wanted to focus on the longest track record of dividend growth because that has shown to offer the greatest potential for outperformance.
Right. Based on the current environment, is there anything that's concerning you or the folks at ProShares about a dividend growth strategy today?
Well, the dividend growth approach is really an evergreen one. Yeah. It's one that it's not super high beta, it's not incredibly defensive. Year in, year out, it has that potential for a nice amount of outperformance. That sort of lack of cyclicality is sort of important these days because you do find that investors have, in many cases, looked for those high yielding stocks, not those necessarily that have grown their dividends, but those with a high dividend yield. And one of the things that's important about those stocks is they do have some of that cyclicality, specifically interest rate risk.
Right.
Last year, the utilities is the poster child sector of high dividend yield. And in the back half of last year, when interest rates, actually rose, you had those utility stocks underperform materially. And then in the first half of this year, when we were all sort of head fake between China slowing and of course, the Middle East blowing up and the Ukraine blowing up, you had interest rates come down, you saw those utility stocks and other high yielding stocks outperform.
Yeah.
That's a risk factor.
It is.
It's a risk factor.
And I kind of look at it this way, there a lot of money is on the sidelines. We're hearing about it here at this conference. People are still scared to go back in. Kind of tells me we might still have a bull market for a period of time. But if you're having a strategy that's dividend oriented, that means that these companies that you're investing in actually have money. So there's that discipline, inherent discipline that you folks have been able to present that makes it that much more attractive to investors, right?
No, I think that's right, Tom. Look, you can get there by doing a lot of busy work and putting on your green eye shade, and you can rip apart balance sheets and you can rip apart income statements and you could look at earnings quality and cash flow, but this is a great shorthand and that's why it lends itself so well to a disciplined and rules-based ETF.
Absolutely. Simeon, thanks for your time today. Appreciate it.
Thank you.